What's up, everybody? It's your boy Stevenson Lindor. I haven't done a webinar in a while. Man, I wanted to just drop a quick video going over some things, one of the biggest misconceptions when it comes to trading, and that's using indicators. And I'm not really big when it comes to using indicators, but I just wanted to go over basically the difference of when applying certain indicators and how it can be useful. And hopefully, when I break this down, you guys have a better understanding of how this all works, right? So let's get to it. Hopefully, you guys see my chart. There we go. All right, guys. So today I wanted to talk about indicators. All right. Now, if you've been following me for a while, you know I'm not really big into using them, but doesn't mean that they're not useful, right? And there's a lot of traders that use indicators, right? Now, the reason why I'm not a big fan of them is because indicators lag, right? And what do I mean by that? Basically, by the time the market tells you, depending on what type of indicator you use. So for example, I have an RSI here. We're going to get into like moving averages and other indicators as well. But most of the time, by the time the market tells you to buy or sell, right, you're kind of late to the party, because you got to understand these indicators, they are telling you, they're trying to give you an idea of when the market is going to reverse. It's telling you, the price is basically about to go on this nice downtrend, it's about to go on this nice uptrend. But there are times when it'll tell you to you're jumping in a little bit too early, or if you're using like moving averages, it's so when price basically goes under the moving average, you're looking for that sell, and then price shoots back up the opposite direction. So it's not that indicators are really bad. It's just you have to know how to utilize them, and actually, most importantly, what's the difference between utilizing certain indicators compared to another. So there's two types of indicators, and most people don't even know this, right? There's leading indicators and there's lagging indicators. Now, both indicators overall lag. All indicators lag. But believe it or not, there's two different types. Now, you have leading indicators such as RSIs, such as stochastics, such as MACDs, right? You got stochastics like this. And then you have MACDs. These are leading indicators. See that? So for example, you see how, and leading indicators, the main difference between leading indicators and lagging. So leading indicators are basically trying to precede the price movements, right? They're trying to predict when price is gonna either reverse, go on an uptrend or downtrend. So for example, right here, Euro USD, see how price was overbought? So like on RSI, you'll have the 70 and the 30. On stochastics, you'll have the 80 and the 40. So when price is overbought, or oversold or overbought, in this territory, it's kind of telling you to basically buy here, sell here. Now, the examples I'm showing you, price would have definitely worked out. So if you would have bought here, you would have made a lot of money, right? You would have bought here, let's info line. If you would have bought here, rolled that all the way to the top, right? Made about 462 pips, right? If you would have sold here, rolled that pretty much to the bottom there, you would have made about 447 pips. So that's a good way to use a leading indicator, because it's pretty much predicting in advance and letting you know when to buy, when to sell, when that reversal is coming. But what happens when it tells you to jump in before the market actually reverses? And that's one of the biggest problems with utilizing leading indicators, right? So indicator, whether it's the RSI or the stochastics, or even sometimes when they're using the MACD. Now the MACD is a little bit different in the sense that, It's measuring the strength of the trend, right? So depending on how big, right? So when this was going on, this uptrend right here, if you look at the MACD, right? This wasn't a big compared to previous uptrends. It wasn't as big. It wasn't as strong. So it's telling you this is not exactly a strong uptrend, right? So this is more so for momentum. But most traders use RSI and stochastics. And again, you're looking for those reversal points. But where a lot of traders go wrong is they'll jump the gun. And it's not necessarily the traders, it's the indicator that you're using. So we'll start with the RSI, right? So for example, when the market is trending, and this is where it becomes difficult using an indicator like an RSI. So we got an uptrend right here, right? This was one big uptrend. Look at all the times price is telling you to sell. Here, right here, right? Price just keeps going up. And look at all these areas it's telling you to sell. Every time price got into the overbought territory, right? Sell, sell. So this is a problem, right? Look at all these areas, right? Dropped here, then shot up, dropped a little bit, shot up, dropped right here. So these are the type of positions most traders take and then lose money, right? Because that's what the RSI does. That's, or more so, that's what leading indicators do, right? They're going to have you jumping in and out of positions because that's how they work. When price is above the 70, it's telling you to sell. When price is below the 30, it's telling you to buy. But it's having you jump into the market a little bit early, prematurely. Now, the best way to utilize leading indicators, and here's the key, the best way to utilize them is in basically when the market's in consolidation, when it's in a sideways movement, right? So right here, market is in consolidation. This would be the best time to use something like a leading indicator in RSI. So if I go down to, like, let's say the 4-hour, right? Now, look how this lines up with the RSI perfectly, right? Now, this was the height of where this channel began. So perfect. Right there. Lined up perfectly. Right with the RSI. So if you would have sold here, you would have made some money, right? Boom. Right here. You would have sold here, you would have made some money. Boom. Would have made a little bit of money. Not too much. Right? Price dropped about, yeah, good 176 pips. So that's pretty good. You would have sold here. Boom. You would have made some money. Price overbought. Right? Sold right there. This didn't break too high above it. You would have made some money. So the best place too, and actually, as you can see right here, when price was even oversold, see, right there, if you would have bought here, you would have caught that buy. You would have bought here, you would have caught this buy, right? If you would have bought here, you would have caught this buy. So the best way to use leading indicators like RSI and also like stochastics when the market is in consolidation, right? Now, with stochastics, you'll be buying and selling a little more frequently. So like, see, when it's oversold over here, if you like to use stochastics, you could have caught that buy, right? When it's overbought over here, you could have sold right there. And basically doing the same thing over and over, buying and selling, right? In a trending market. Now, you have traders who love to use moving averages, right? And moving averages is lagging indicators, all right? Now, what are lagging indicators? Lagging indicators It's one that follows price movement and has less predictive, basically, qualities, unlike RSIs and stochastics, right? So what does that mean? So lagging indicators such as moving averages, Bollinger Bands, right? They're very useful and they're excellent to use when in a trending market. Make this a little bit bigger. Boom. So using moving averages are perfect in a trending market. All right. So sideways market or consolidation, leading indicators. In a trending market, you want to use lagging indicators. And basically, like moving averages, like a Bollinger Band, and also getting a lot of questions with this, also with, this is a very popular one, the Ikumoku cloud, right? How many people use that? Well, we'll go over the Ikumoku cloud afterwards. But in a trending market, it's the best to utilize lagging indicators. So every time price is above the moving averages, you're looking to buy. And one good way to implement as a strategy when you're using lagging indicators like moving averages, Bollinger Bands, the Ikumoku cloud is, you want to draw a trend line, whether on an uptrend or whether on a downtrend, right? Always draw a trend line. And basically, as long as price is below that moving averages, you can look to sell, right? So then when price pulls back, as long as it doesn't break your trend line, comes back under, you can look to sell. Every time, look to sell. Only in a trending market. That's when moving averages are powerful, most powerful. In a trending market, like for example, like this right here, right? Not trending, but consolidation, back and forth. See, moving averages in a way not so useful because they're gonna have you buy, selling every hour, right? There's some of you guys who are trading and you use a moving average. If you ever caught yourself, you keep buying and selling because price keeps going above or below the moving average. So you see right here, you're selling. Oh, it went back up. Let me buy. Oh, it's going back down. You're selling. Go back. Right? That's very frustrating, right? Because the market, this type of indicator is not very great during consolidation, right? Because it's just moving sideways. And because it's lagging, because by the time price is telling you to sell when you should have been selling at the height over here, right? See how your stochastic, look how the stochastic is telling you to sell right at the top here, right at the top here, right at the top here, right at the top here. Notice price overbought. This is where you're supposed to be selling. With moving averages, you're late to the party because you got to sell once price is below. So during consolidation, you're going to be buying and selling a lot, getting out of your position. And that's going to be very frustrating as a trader. So it's best to utilize something like a moving average or even the Ikumoku cloud or the Bollinger Band, right? Bring that up real quick. Right? Look at that. So the Ikumoku cloud, right, which is very, very popular. A lot of traders like to use this. You're basically buying when price is above the cloud or selling when price is below it. But look, when the market is in consolidation like this, when it's just moving sideways, right? How do you buy and sell when the market is moving sideways like this, right? Ikumoku cloud is best, as you can see, when it's below the cloud in a trending market, right? So people like to use the Ikumoku cloud as long as you see how price is below the Ikumoku cloud. So now you're comfortably selling in a trending market. But when it's moving sideways, it makes it very difficult because you're going to be in and out of your position. So when the market is moving sideways, it's best to use leading indicators like an RSI, like a stochastic, or if you like the MACD. But when the market is trending, this is where you want to refer and go back to either a moving average or the cloud or Bollinger Band. Now, again, all indicators lag. You got to understand, this is the Forex market. It's over a $5.3 trillion market. All that data, all that information, you got to understand all these indicators, it takes time for it to process all that data. So by the time it's done processing that information, the move has pretty much already started, right? So leading indicators, they're jumping the gun. They're going to have you jumping a little bit early, sometimes before the move actually happens, right? See, as soon as price started to tell you to sell, right, it didn't drop right away. It didn't really drop until, you know, price got all the way over here. If I use this measuring stick, price is already in the overbought territory right here. It didn't really drop until, so if you look at it, April 10th, it told you to sell. And April 23rd is when it really began the downtrend, right? That's what leading indicators like these do, right? And if you go by a moving average, it's not, you're gonna be a little bit late to the party. So what you want to do is whatever strategy that you're, you utilize, whether you're a supply and demand trader, Elliott waves, whatever the case may be. I'm not saying you can't use indicators, right? They're good. They're a good tool, especially to use in conjunction with a strategy that you already have in place, right? So for me, for example, I know I love market structure. I love identifying patterns like flag patterns. So for example, when I identify a flag pattern like this, price is pulling back, this is how you can use indicators to your advantage. So I see a flag pattern like this, use it in conjunction with an RSI, perfect. Price is overbought, so it's under my trend line. So this is a very good area I would like to sell. Incorporating a moving average, I can wait for price to go below that moving average, break there, close below there. Now, boom. Now I got my stop loss right there. I got my entry here, and then I got a nice move to the downside. See that? All right. For those who actually trade with me, boom. This is exactly how I trade. You got a nice 377 pip move to the downside, right? And that's me incorporating indicators. That's how you properly use indicators. You don't just buy or sell because price says buy or sell, because if you do that, then you're going to be screwed. Because just right here, perfect example, price is telling you to sell because it's oversold, and then price went up. It dropped, barely dropped, and went all the way up about over 100 pips. That's a losing trade, right? So at the end of the day, you still need to understand structure, how the market is moving. So what I like to do, and if I'm going to use an indicator, I like to identify patterns, right? So if I see a flag pattern like this, and then prices oversold or overbought on my RSI or stochastic, right? Price closes below my moving average or below the cloud or below even a Bollinger Band, right? So Bollinger Band, right? Boom. So as you can see, price closed below my Bollinger Band. Now I have all the confirmation, all the confidence in the world to sell. All right. And this is one way to incorporate and utilize indicators. Because I was getting asked this a lot. A lot of people were messaging me. I know you're not, I know you don't use indicators, but for somebody who does, how would you incorporate it? And what's the best indicator? Now, when it comes to indicators, it's all relative, right? There's no special number, right? Like people always ask me, well, what's your RSI settings? Right? There's nothing special. You can 14, whether it's 14, 7, 20, It doesn't matter. At the end of the day, like I always say, you have to understand the market as a whole in order to trade. If you don't understand how this is moving, none of this is going to help you, right? Indicators are only useful when your knowledge in the market is strong, right? If you understand how the market is moving, then indicators are good. It's just extra confirmation, and nothing's wrong with extra confirmation, right? So like I said, when I see flag patterns like this, when I incorporate a moving average, I got that much more confidence when I trade. So like I said, people who know me know I'm very big on flag patterns, identifying this. So instead of jumping the gun, as you can see here, my RSI not completely overbought territory, but I have a flag pattern here. What do I see? I see a breakdown plus price close below the moving average. I can still comfortably take my sell. Why? Prices under and below my trend line on a bigger structure. Do this trend line here on this daily. Go down to the 4-hour, identify the flag pattern, price close below not only the trend line, but moving average. Perfect. I got my stop loss above, and then I got my move to the downside. All right. So you can do this on any currency pair in the market right here. Same thing. See all these flag patterns, right? See, this goes very well with a moving average. Look, every time price closed below the moving average, looking to sell. Every time. Flag pattern created, excellent opportunity to sell. Prices oversold. I'm just waiting for candlestick to close below the moving average. I sell. Perfect. Everything lines up. Right there, entry there, stop loss there, move to the downside. And then continuation. So again, leading indicators like RSI, stochastics are great during consolidation, sideways movement. All right. When the market is in a sideways movement, when the market is doing something like this, back and forth, it's moving sideways, no true direction. This is when indicators like RSI and stochastic are great, right? There, look at that. Lines up perfectly with the RSI, stochastic, and right there. Notice that. Look at that, right there. Perfect. That's when you want to pay attention to your stochastic and RSI, leading indicators, right? I don't want to pay attention to my moving average, because if I do that, I'm going to be buying and selling everywhere. Look at that. I bought right here. I go to sleep, come back, wake up, price is down here. I sell down here. What happened? Price comes back up here. And then it's back and forth, back and forth. You want to use the moving average when we're in a trending market. Now price is in a trending market, as you can see. Now I have a comfortable sell. Once price broke out of this structure here, this sideways market structure right here, now I got a trending. And now I'm just identifying patterns. Identifying patterns. So I got 1 flag, 2 flag, 3 flag. And every time price breaks below my flag and close, I got to sell. Boom. I got to sell. Boom. I got to sell. Boom. All right. So I just wanted to shoot this quick video, guys, showing you the difference between leading and lagging indicators. At the end of the day, they're both strong. They're both very useful. You just got to understand the difference between the two, understand when to utilize one against the other, and how to use all of them in conjunction when you're trading. All right, guys. Hopefully this video has been helpful. Leave a comment if you have any questions, any concerns. Hope you guys always getting valuable, stay profitable, stay always a student. Have a good one.